Good afternoon, everyone, and welcome to Credit Myths and Facts. I am Holly Zuge, and I'm with the Pennsylvania Housing Finance Agency, and I'm so happy to be here as part of employee financial wellness for Pennsylvania state employees. So let's get started. Today, we're going to talk about the types of credit, getting and using credit, credit reports and scores, managing debt, and avoiding predatory lending. So, credit myth, is it true or false? The bank just gave me $1,000. Gave me $1,000. The answer is false. They have $1,000 that they are going to let you use it. So do you remember when you got your first credit card, how exciting it was? Oh my gosh, I'm getting other people's money. Yay, I can use it. It's my money. No, wait, it's not your money. It's other people's money. Again, this is not your money, it's other people's money. So we refer to other people's money in two ways. First of all, we say credit. Credit is just the permission to use other people's money, whereas debt is other people's money that you've used and must be repaid. And I'm very guilty about interchanging those two words. So just know that there really is a difference, but again, I interchange them. So forgive me for that. So types of credit. There is revolving credit, which means it's reusable. Examples are credit cards. So you can, spend money, spend other people's money, pay it off at the end of the month, and you can reuse that. It's reusable, revolving. So payments are flexible based on the balances and the purchases that you make. And if you default, which means you don't pay the bill, purchases will be denied. You'll be charged fees, and penalty interest rates will be effective immediately. So that's revolving. The next type of credit is installment, which means once and done. So you borrow money, a certain amount of money for a period of time, and you pay it back in installments, and you can't use it again. If you need to have more credit, you have to reapply. So an example, an auto loan, a mortgage loan, student loans, things like that. So payments are fixed, again, based on the amount that you've borrowed, the time that you promise to repay, and at the interest rate that the lender charges you. And if you default, again, meaning don't repay the loan, the item that you pledge, whether it's a home or an automobile, can be repossessed. Or in the case of federal student loans, you might have wage garnishments as well as tax return garnishments. The third type is service, which technically it's not a type of credit, but really it is if you look at it. So these are the things that you use on a month-to-month basis. So your as the example here, cell phone, other utility bill, and it's like having a 30-day credit window. So you use the service and then you have to repay it. So again, that's like a 30-day credit window. And of course, your payments are based on your usage, and if you default, that will mean the service will be shut off. So those are the three basic types of credit. Now, types of debt, I mentioned this before. Secured debt is you're pledging something, you're promising to pay, but you're pledging that item. So if you don't pay, it can be repossessed. The next is unsecured debt, which is kind of like a pinky swear. I swear that I promise to pay it back, but there's nothing that the lender can take back if you don't pay it. However, the lender can take you to court and sue you for the amount of that debt. And then last are garnishments. Again, technically it's not a type of debt, but it's a seriousness of the debt. So these are things that if you don't make the payments, you can have those wages or that tax refund garnished. So this would be child support, federal student loans, things like that. So those are the types of debt. So credit myth, true or false? Credit reporting agencies approve or reject a person's request for credit. So the answer to that is false. It's the lender that approves a person's application for credit. So what do lenders look at? So they look at what I call the 5 C's of credit. So the first is capacity, or basically income. Do you have the income to repay this loan? Next is, if I can get this to work, next is capital or cash. Do you have cash for a down payment or cash to pay fees and closing costs? The third one is collateral, that guarantee. What are you pledging to promise to pay? So that would be the value of the automobile or the value of your home. Lenders don't want to lend more money than that item is worth. So they will look at the value of that collateral. And then character. No, and this is not what Looney Tunes character you are. It's your history. So how have you repaid your obligations in the past? And last is condition, which we don't have a lot of control over condition. So this would be the economic conditions. You know, what happened as a result of the Great Recession in 2009. Excuse me. What was happening was the lenders were limiting credit because of that economic stress that was going on in the economy. So again, we don't have a lot of control over condition, but it is a factor. So credit myth, true or false? If I qualify for credit, I must be able to afford it. Oh, wouldn't that be nice? The answer is no. You really need to determine what you can afford. The lenders look at certain, excuse me, the lenders will look at your gross monthly income when determining whether or not they're going to, excuse me, determine if they will extend you credit or not. And we know that we don't live off of our gross income, we live off of our take-home pay. So this is the dream purchase, right? We're going to buy a car. Oh, doesn't that look fun? We're looking at the documentation, we're looking under the hood, we're signing the paper, shaking hands, so we get the keys to the car. Isn't that an ideal way to buy a car? The reality is, though, the reality is, how many of us have dealt with a guy like this, Crazy Eddie? And what's the first thing that Crazy Eddie says to you when you go into a car lot like this? They'll ask you, what kind of monthly payment are you looking at? Well, the answer is, if we go shopping for a monthly payment, that could actually end up costing us more in the long run. So let's put ourselves in this situation. I'm going to use myself. Okay, going into the auto dealer, and he's asking me, well, okay, what's your monthly payment? And I say, well, my budget is about $200 a month. I really want to stay under that. Okay, so let's say I'm looking at a car for $10,000. This is what the sticker price says. I really like this car. $10,000 would be the purchase price. Interest rate would be 7%. The term, or how long it takes to pay back that loan, is 48 months or 4 years. The monthly payment would be $239 a month, and total payments of $11,472. So if you take 48 months times 239, that gives you the total payments, which means the cost of that loan is $1,472. That's the cost of credit. Well, of course, that $239 is above my budget of $200 a month. So Mr. Eddie says, well, let me see what we can do for you. Let me go talk to my manager. So of course he goes and talks to his manager, and they're talking about nothing, nothing dealing with the car, but sports and things like that. It comes out a couple minutes later and he says, Holly, this is what we can do for you. So he says, if you make a $2,000 down payment, that brings your monthly payment to $192. Did he meet my objections? Well, of course, because it's $192, which is under the $200 a month. But let's take a look at what that really means. If I make the $2,000 down payment, my loan would be $8,000. My interest rate, 7%, 48 months. The total payments, 48 times 192, would be $9,216. So the cost of that loan is $1,216. Well, wow, the cost of that credit is less, so that's great. But let's say I don't have the $2,000, so I'm not really sure if this is going to work for me. Well, okay, Eddie says to me, Holly, you're a really nice person, and I'm going to go talk to my manager again and see what we can do for you. So of course he goes and he talks to his manager. Again, they're not talking about anything remotely related to this. Comes back and he says, Holly, this is what we can do for you. If you extend the loan for just 1 year, your payment will be $198 a month. Okay, that sounds good. He met my my restriction of $200 a month. But let's take a look at that, what that really means. So that $10,000 loan, 7% interest. Now I'm paying it back over 60 months, and total repayment is going to be $11,880. That means the cost of that loan is now $1,880. So I go from the original sticker price of $1,472 as cost. Now it's up $400 just by extending that period over a 1 year period of time. So now, again, I'm like, whoa, that's, I don't really think that buying a, $10,000 used car warrants a 5-year loan. So I tell him, okay, I think I'm going to go shop around. And he says, whoa, 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 wait a minute. Let's see if we can work something out. So he goes back and comes back with, I've got some credit issues. This is a problem, right? So he says, well, you don't qualify for the 8.5% interest rate because we've checked your credit now. They have a permissible purpose to do that. So your monthly payment would be $246 a month, 48 months, $11,808 it would cost. That cost of credit total would be $1,808. So whoa, I'm, where did this come from? Maybe I could scrimp and save and do the 239, but that 246, wow, that's really high. So he says, wait a minute. Just want to let you know that before you walk through the door, we had 2 calls on this car, and if you leave now, we're not going to have this car available for you. So he says, let me see what I can do for you. Hold on a second, we might be able to work things out. So he goes back to his manager and he's like, okay, we've got her now. She's not going to go shopping around. Let's see what we can do for her. So he comes back and he says, well, we normally don't do this, but if you make a payment of $340, a one-time fee, we can get that interest rate back to 7%. What does that really mean? So $10,000, 7%, we've got that $239 a month. That means total payments are $11,812, including that $340 fee. That's actually more than the 8.5% interest rate. So the moral of the story here is we have to be careful about telling someone what our monthly payment that we're looking for. Now, granted, we have to make sure that the payment amount we can afford is our, in our monthly budget or monthly spending plan, but to make that the focal point of the transaction can really get us into trouble when you're taking into consideration the 4 factors of finance. So what are those 4 factors? Okay, so we looked at down payment. So when you make a down payment, it goes up, right? Your monthly payment will go down because you're borrowing less money and the cost of credit will be lower. If your term goes up, which means you're extending that period of time in which you're repaying that loan, the monthly payment can be lower, but the overall cost of credit is higher. So if your interest rate goes up, of course, your monthly payments are going to go up and the cost of credit will go up. And if you're paying fees, if you pay that fee up front, it's not going to have any effect on the monthly payment, but of course the cost of credit goes up. And if you decide or have the ability to roll that fee into the loan, well, now you're actually paying interest on that fee, which means your monthly payment, of course, is going to go up because the amount that you're borrowing goes up and the cost of credit is going to be even higher. So if we understand how these things are manipulated, we can better make decisions for ourselves based on the overall cost of that loan. So how do we know if we're getting a good deal? Well, there are certain disclosures that have to be given to you prior to you opening up accounts. And this is a sample disclosure for credit cards. So you have to be told about the interest rate and charges, which means interest rate on purchases, balance transfers, which might be different. If there are any penalty interest rates because you've made a late payment or you've gone over the credit limit, things like that, that has to be disclosed. And then what's your due date to avoid any interest charges, because you can pay off the balance of your credit card and not be charged interest. And what are the minimum interest charges? So it's usually a flat fee like $2 or something like that. Okay, so oops. Now fees. There's different setup fees. There may be setup fees and maintenance fees for this account, annual fees. You might have a transaction fee if you've taken out balance transfers or taken money out on an ATM. There might be penalty fees. Also, what must be disclosed is how the interest rate is calculated and conditions of any interest introductory rate you may have. They love to get us with 6 months 0% interest. Just open up this account. So when does that bonus time period end, and when do you need to make that payment to avoid making sure that you're not paying that as the 6 months expires? All right, so this is a disclosure. It's called the Truth in Lending Statement, and this is for installment loans. So let's take a look at that loan on that $10,000 used car purchase that we were going to engage in with Crazy Eddie. So the amount financed has to be disclosed. So what is the principal balance? How much are you borrowing? Then what needs to be disclosed is the number of payments, the amount of each payment, and when the payment is due, the beginning date, and how often. So in this case, it would be a monthly payment. And that gets to your total payments of $11,472. 48 times 239. That's the total amount that you will be repaying. Your total sales price, though, takes into consideration any fees. Okay, remember we had that $340 fee, and that's where that comes in. There's a $340 difference. So your total sales price, again, is with including all those fees. And then what happens is, okay, the total finance charge, again, with that $340 included. Then you have your APR. So what this is what the actual rate that you're paying, which includes those fees. Now we see the note rate here is 7%, but when you add in that fee, it actually bumps up to what you're really paying, 8.5% overall annual interest. So it's important to understand the difference between the note rate, so that's 7%, and how much you're actually paying, or your APR. The closer those two numbers are, that means the less expensive that loan actually is for you. And then here are some disclosures for mortgage loans, which is definitely more in depth because there's it's a bigger transaction and there are more fees associated with it, more things that need to be done in order to buy a house. So on the first page, you'll see your loan term, your interest rate, your payment, et cetera, et cetera. But the APR, which is that important number that you need to compare your loan rate with, is on the third page. So it's kind of hidden all the way back here with your annual percentage rate, as you can see in that box. So again, mortgage disclosures are a bit more complicated. And if you are in the market for buying a house, you can actually visit the CFPB, which is the Consumer Financial Protection Bureau. Their website actually has a sample disclosure, and they have an interactive form that will discuss all the different sections of it. So I encourage you to go to their website, and that's consumerfinance.gov. So credit myth or fact, true or false? Credit reports are all the same. The answer is no. And why aren't credit reports all the same? Well, the lender chooses to which bureau they're going to report. And they don't have to report to all three, and we'll talk about those in just a second. They can choose one, they can choose all of them. And I often get the question, well, why doesn't my landlord, put my rental payments? I have a good history of rental payments, but they're not reporting it to the credit bureaus. And the reason is because it costs them money. It costs the landlord, the lender, whoever money to make those reports. So of course, a landlord, typically won't, want to pay that fee to report. But of course, if you're late on your rent, they will make that report to the credit bureau. So again, it costs money, and that's why they're not all the same. So let's talk about credit reports. So a credit report is your overall snapshot of using OPM, or other people's money. So the credit report will have who you've borrowed from, the lender or the creditor, what type of account it is, revolving installment or service in the case of being late, the date the account was open, have you paid as agreed or you're late, and of course what your outstanding balance is. And the information is compiled from creditors. So the credit reporting bureaus don't take any, they're not responsible for the quality of that information. They're just, taking it from the lenders and spitting it out into a report. And credit reports are individual, not joint. But if you have a joint account, a joint credit account with someone, that information will be put on your report as well as theirs. And credit reports change usually every 30 days, if depending on the reporting cycle and when during the month that it's reported, but it changes based on your activity. So the payments that you've made, if you've been late, if you made any applications for new credit, if there are any legal actions of financial matters such as child support or back child support, or for example, if you, as I mentioned before, the credit card company takes you to court to recover their payment, that'll be on your credit report as well. And again, it's typically every month that you will find the changes. And also, if there, as I mentioned before, if the information is not correct on your credit report, it's really important to file a dispute with the credit reporting agencies. And what these agencies will do is they will contact your creditor and say, hey, our client is disputing this information. Can you confirm that it's correct? Now, if the lender comes back and says, oops, my bad, the information isn't correct, then the credit bureau will remove that information. If the creditor says, yes, this information is correct, the bureau will let you know, and then it's up to you to work with the creditor to try to reconcile that report. So again, it's important to look at your credit reports and dispute any items that are incorrect. And just know that you cannot pay someone to remove correct information from your credit report. Don't be, taken by, hey, you pay us and we'll remove stuff from your credit report. You can't do that. What they might do is help you fill out dispute forms, which you can do that on your own without a fee. So let's talk about the bureaus and how we get our credit reports for free. It's important for free. So here are the 3 credit reporting bureaus: Equifax, TransUnion, and Experian. And you can get your free credit reports at the website annualcreditreport.com. Remember, this is the one and only free site. Don't be misled by creditreport.com or free credit reports. No, this is the one and only website that you can get that for free. And here on the left-hand, lower left-hand part of the screen, you can see what just a screenshot of their website, so you know that you're at the right place. You can also get it by phone and get them by mail as well. But note that these free reports do not contain your credit score. Now, typically or normally, and we know that now is not normal, normally you could get a free copy of your credit report every 12 months from each of the bureaus. But due to COVID-19, you can actually look at your credit report for free on a weekly basis until April of 2022. So, and the reason is because of the foreclosure moratorium, the student loan moratorium, the mortgage foreclosure and eviction moratorium. We want to make sure that if you are involved in one of those forbearances, you want to make sure that the information, you are not being penalized for that information, meaning the missed payments are part of, or put on as a negative on your credit report. So again, it's important to do that. And you can only, you determine whether or not you need to check them every week, but just know that that is available. And once April of 22 comes along, we should be back to the once a year requesting your report. Okay, so let's talk about credit scores, because we're all about the number, right? We'll get to that in a minute. I forgot this question. True or false? My employer must have my permission to see my credit report. The answer is true, and that has to be in writing. Now, usually if you have an application that you're filling out, it'll be in the fine print at the bottom saying, by signing this application, you're giving us permission to see your credit report. And the question is, why would an employer want to see a credit report? Well, a couple of reasons. How you handle your personal money may be indicative of how you would handle a company's money. And of course, a company doesn't want to put their financial payments and things like that in jeopardy. Also, they might be worried about company theft. If you're having trouble paying your bills, not to say that you would do that, but employees might be tempted to, do that corporate theft in order to, pay some of their bills. So again, it just depends on what your job is and, how the employer looks at credit in terms of corporate theft. Okay. Now we're going to go on to credit score. So what's your number? We're all about the numbers, right? So a credit score is a number which represents how likely a person is to default on a loan. So the higher the better. The higher means that you are less of a credit risk, meaning you have a good history of paying back your debts. So how the score is calculated, it's based on a complicated statistical program using the qualitative and quantitative information in your credit report. So there are various scoring models used for different lending purposes. The most common is the FICO score. So what does this actually mean? Okay, what's in that credit score? So my credit score, here's another myth or fact, my credit score will be lower if I view my credit reports. The answer is no. You can view your reports as often as you like, and that will not affect your score. So I often get the question of, or the comment, well, if I check my credit report or if I apply for new credit, my score is going to drop 10 points. And there's no direct correlation for that, which means our information and our score is representative of our personal information. Somebody who reviews or applies for credit, maybe their score will drop 20 points. You don't know. It's just based on your individual situation. And here are those factors. So 35% of your credit score, your FICO score, has to do with your payment history. So have you paid on time? And then another 30% is the amount of debt that you are carrying. So the lower the better. Then the length of history is 15%. You really can't change that. It is what it is. You started having or using credit when you did. You can't change that. And then 10% has to do with the types of credit. And for scoring purposes, secured debt is seen as a higher value debt because it's more difficult to get. So in theory, you have to be more responsible to have installment debt. And then last but not least are these inquiries. This is where I was saying about if I apply for new credit, my score is going to drop. Well, and again, that's not necessarily true. It depends on all of these other factors as well. Now, if you have a poor payment history and you have a lot of debt, another inquiry will probably drop your credit score. I can't tell you by how much, but just know that it could have, you're more likely to have an effect by applying for new credit, if you have a poor payment history and you carry a lot of debt. On the opposite side, this is how we improve our credit. Pay on time and lower the amount of debt you have. Those are 65% of your score. Those are the factors you really want to focus on when either improving your credit or worrying about applying for new credit and how that would affect your credit score. So why are we so worried about credit scores? Well, the cost of poor credit. It costs more if your score is lower. So getting back to our $10,000 loan for 48 months on a used auto loan, and these are actual rates as of a year ago, 2020, July of 2020. But if your FICO score was between 720 and 850, which is the maximum a FICO score can be, your APR would be a 4.7%, monthly payment $229, and the total interest paid for that cost of credit is $989. So if your credit score was between 660 and 689, your APR bumped up to almost 7.5%. Your monthly payment would go up, and look at that cost. Total interest paid is $600 more. So it's costing a lot more money just from having a lower credit score. And then of course, if you're dropping, below 620, your APR would be almost 19%. $299 would be your monthly payment, and that cost quadruples more than that to $4,349 is the cost of that $10,000 loan. So here's another question: credit myth or fact? Information on a credit report, it only affects a person's finances. And the answer is no. It affects a lot more than just your finances. So it affects our housing. So if you apply for, make an application for a new apartment, that landlord is going to check your credit. Of course, if you're looking at buying a house, credit becomes very important if you don't have the cash to pay for the entire purchase. And it can affect our insurance rates because you have you are seen more as a risky person if you're not meeting your obligations. So it can affect your insurance rates, and we talked about this before. It can affect your ability to get a job. So it's really important to have good credit, and not just, again, for the lower cost of borrowing, but all of these other factors matter as well. So how do we use it? What is responsible use? So use only what you need. Don't extend yourself more than what you need. Invest in yourself. Buy assets. So education is an asset. A car is an asset that you need to get to work to make money and to pay your bills. Make sure that you are keeping the amount of debt low. And don't be fooled by those payment terms, as we went through that example, can affect your cost of credit. And then last but not least, pay on time and every time. So that's how we should use it. So how do we know when to say when? And these are a couple of ratios that are used to determine if you're overextending yourself. And the first one is your debt to income ratio. So how much of your monthly income goes towards paying down debt? The guideline should be less than 10% for your consumer debt. And that would be your auto loans, your student loans, and things like that. If you have a house, the housing portion should be less than 28% going towards your housing expenses. So, guidelines, if you look at combining your consumer debt as well as your housing debt, that would be 38% is a guideline. Now, this is of your gross monthly income, though. So taking your monthly debt payments divided by your gross monthly income, and that's when you will get that's how you get your debt to income ratio. So that's important. Then we have utilization ratio, and this means how much of your available credit are you actually using. So it's your total debt balance divided by your total credit limit multiplied times 100, and that gets your utilization ratio. It should be less than 30% for each of your revolving account, and try not to have any account that your utilization is 100%, which means you're at your credit limit. And that 100% is not a good score in this case. So again, try to keep that below 30%. So here are some warning signs. Your ratios are too high, you can't make minimum payments, using one credit account to pay on another, robbing Peter to pay Paul is the common phrase. You get calls from creditors, and of course, if your accounts go into collection. We mentioned this before, true or false. All credit repair companies can fix credit problems, and we know the answer is no. And there are a couple of ways to help us repair our credit, but let's take a look at those. But just know that you can't pay a company to repair all of your problems. So how do we fix it? We can do it on our own. We can go to credit counseling. We can enroll in a debt management program. There are debt settlement options and bankruptcy. So let's take a look at that. So on your own. So this is where you need to establish a usable, manageable money map, which is otherwise known as a budget. And we prefer not to use the word budget because it feels very restrictive and negative. So we like to have a money map. Dissecting your debt for payment strategies. So understanding, how much you owe, how much, the interest rates, and looking at, the minimum monthly payments and things like that, and to come up with that strategy of the fastest reduction. Contact creditors and ask for a reduced interest rate or reduction in payment, or if there are any refinance options. Also, another thing to do would be to maybe change the due date to correlate more with your payments or your income or your paychecks. To say. So ask for those options, and whatever you do, make good on your promises and make those payments on time. So here's some pros. You take control of your situation. You're going to save money on additional late fees or penalties if you can work that out with your creditor, and it reestablishes that good payment history. What are the cons? Well, of course, it's going to take time to pay off debt. You may still have to manage multiple accounts and payments, but again, at least you are taking control of your situation. Next is credit counseling, and this would be contacting a nonprofit credit counseling agency that is part of the National Foundation for Credit Counseling. They're located all over the country, and Pennsylvania, we have a large network of credit counseling agencies as well, and they are most of them are part of our housing counseling network. So you can find a credit counselor by either going to the National Foundation for Credit Counseling website, which is N as in Nancy, F as in Frank, C as in credit, C as in credit.org, or you can go to PHFA.org to find a local agency that you can contact and get some credit counseling. So what happens in credit counseling? The counselor will evaluate your credit report and look at your debt. They'll help you with that budgeting process. They will help you with the repayment strategies, and they can also help contact creditors and do that, asking of reduced interest rate payments or et cetera, et cetera. So the pros, there's a professional analysis of your situation. It saves money in addition to late fees or penalties, and it reestablishes that good payment history. And I have to say also that most credit counseling, nonprofit credit counseling agencies do their services for free. The cons, it takes time to pay off debts. You may still have to manage multiple accounts and payments. All right, so what's a debt management program? So a debt management program is often offered by the nonprofit credit counseling agencies. So this takes that credit counseling to the next level. So you're going to go through the credit counseling process. The agency will contact your creditors and negotiate a lower payment amount and agree to a manageable repayment plan. So what happens is you make a monthly payment to the credit counseling agency, and they will disperse that payment to your creditors. So basically, they're taking control of that. You write the check, one check a month. So again, the pros is professional analysis of your situation. You're saving money. You're establishing that payment history, and then writing one check per month to the nonprofit credit counseling agency. So it'll take time to pay off, within 2 to 5 years, again, depending on what your situation is. You may not qualify for new credit during that period of your debt management program. Now, the DMPs are not specifically reported to credit counseling agents or to the credit reporting bureaus, but what will happen is the creditor will look and see that the credit counseling agency has pulled your credit, which means you're going in for analysis. So they'll look at that as a negative, even though you're, again, trying to take control of your situation. And there will be a monthly fee for this, might be $25. And again, you have to determine if this is right for your situation. I know many people get frustrated with, writing 8-10 checks a month, depending on what their debt situation is. And this might be an option, but again, just know that there would be a monthly fee associated with that. Next, we have debt settlement, and you've probably heard this: settle your debts for pennies on a dollar. Well, that's great, but this is the problem with debt settlement. Your accounts have to be in collection. So if not, and you are making those payments, the debt settlement companies will tell you to stop making your payments immediately, and then open up a separate savings account, put those payment amounts in there so that you can build up a large amount for debt settlement. They will contact your creditors once you have a large amount in that account and negotiate a payoff, which again is paying less than what you owe. And then they'll disperse the settlement payment to your creditors. So the pros, you pay less than owed. That's about it. The cons, there are high fees associated with this. And it is against the law for debt settlement companies to collect an upfront fee. They have to take it off the back end. So be aware of that, as well as you may have to claim that forgiven debt on your taxes as income. Creditors may still try to collect on accounts. And again, there's immediate damage to your credit if you've been making those payments before. Just one backtrack on the debt forgiven. If it's over $600, then that you will get a 1099-C and have to report that on your income taxes. So be very cautious of debt settlement. Think about it too. If it sounds too good to be true, it probably is. And one of my favorite commercials out there, not favorite really, I'm just making fun, but it's don't let the credit card companies think that you have to pay back the debt. Well, there's always going to be a penalty, and it's going to be your penalty, not the debt settlement company. Last but not least, there's bankruptcy, and there's a reason for it. People, we get into over our heads sometimes, and this is a way that you can sort of start fresh. You have to attend pre-bankruptcy counseling, and you will be put through a means test, which means that you have the ability to pay back some of your debts. And if you can do that, you will be put under Chapter 13, which is simply some debts are forgiven and some debts you're paying on. They will notify your creditors, you have debtor education, and then the courts decide if you are approved or denied. So the pros, some or all of your debt may be forgiven. It may be faster than a repayment plan. It's generally not taxable, but there are some exceptions. The cons, not all debt is forgiven, alimony, child support, things like that. It will affect your qualification for new credit, and usually new creditors won't touch you for at least 2 years after that. And depending on the filing, it may report it on your credit report for up to 10 years. So if you file Chapter 7, which is different than 13, Chapter 7 is your total forgiveness of debt, and you're not on a payment plan, that will be on your report for 10 years from the date of discharge. Okay, we're coming up to our final topic here. True or false, the safest place to get a loan is a bank or a credit union? And the answer to that is yes. Mainstream banking institutions are safe, unlike the loan sharks or pawn shops and things like that. So let's take a look at that. Let's take a look at predatory lending. Some things are too good to be true, as we mentioned before. So this is a delicious burger. Wow, this looks really good, and I haven't had lunch yet, so I'm kind of anxious to have lunch based on this burger. So it took 3 pounds of ground beef, 100 hamburger buns, 2 cases of lettuce, dozen tomatoes, vegetable oil, super glue, paintbrush, glycerin water, all that good stuff to make that beautiful looking burger. So again, things are not always what they seem, and we have to be avoiding predatory lending, or again, sounds too good to be true. So here are some signs of predatory lending. If a lender says, "Oh, fudge your income," or "We don't need any proof of your income," high annual percentage rates, high pressure sales. This offer is only good for today. We finance everyone. That's one of my favorites too. No credit, no problem. We'll just charge you more. Don't sign a blank form. Don't let a lender say, "Oh, we'll fill this out." You don't need to fill this out now. You don't know what they're going to put on that form if you've signed it and it's blank. Changing the terms at closing. That's why you have those disclosures that we talked about. Bring those disclosures to the closing table to make sure that things have not changed. Don't worry, we'll take everything. We'll take care of everything. Again, these are some of the signs. If you just have a bad feeling, it's better to walk away from a deal than to get into something that is going to, hurt you financially for, a couple or many years to come. So again, be wary of predatory lending. And at PHFA, on our website, phfa.org, We have a brochure that talks about predatory lending, and especially in home buying as well as home repair financing. So be aware of that, and that is available, download for free from our website. Woo, we made it through. That's a lot of information in 45 minutes. So what did we cover today? We talked about the types of credit, getting and using credit, credit reports and scores, dissecting your debt, and avoiding predatory lending. So I thank you once again for asking PHFA to be part of your Employee Financial Wellness series, and wish the best of luck to you all.